This podcast is brought to you by Sabio, a leading CTV advertising platform purpose-built to help brands effectively reach, engage, and validate streaming audiences. For over a decade, Sabio's platform has combined deep industry expertise with innovative technology to meet the needs of an evolving media landscape. Ready to unlock the power of CTV advertising? Learn more at sabio.ws/podcast. That's sabio.ws/podcast. This podcast is brought to you by The Current. Ever wanted to sit down to a candid conversation with the marketing leaders of the world's biggest brands? The Current podcast is your chance. On The Current podcast, you'll find exclusive interviews with the experts and trendsetters who are on the front lines of digital advertising, and they always leave the ad tech jargon at the door. Subscribe to The Current at www.thecurrent.com or anywhere you get your podcast today. Welcome to the Marketecture Podcast. I'm Ari Paparo. I'm here with Eric Franchi, and we have a really exciting show today. So we have Marc Guldimann, who is the CEO of Adelaide. And so Marc is here because we were really interested in hearing more about attention and attention metrics. So even though he's a vendor in the space, we're asking him to give us kind of a 101 tutorial about everything relating to attention, which I'm really interested in. Eric, what are you kind of looking forward to here?
Yeah, I'm looking forward to talking to Marc about a few things. So number one, attention in 2024 has gotten super hot. So apparently there's like a couple dozen attention startups out there, Adelaide being, I think, one of the ones that's most well known and a leader. So I want to know, why attention matters all of a sudden.
Right.
And then also into the methodologies, because how is this being measured? What are the different types of attention? What are the technologies used to understand attention? How it connects to outcomes. I'm just looking forward to a deep dive with the guy. And obviously, as an investor, I've spent a bunch of time, and he thinks about this stuff in a really deep way.
Yeah, and there's also a lot of news this week. There's some earnings with Magnite talking about Netflix, how important they're going to be. We also, late breaking, have a short seller going after Zeta, and Viant acquired Iris TV. So we're going to have a lot to talk about. Quick housekeeping. So this week's vendor interview was with ShopSense AI, which is a really interesting company. You're an investor in that too, Eric, right?
We are, yeah.
Okay. So ShopSense.ai, they basically enable broadcasters to have second screen commerce. So you can basically, while you're watching TV, they have a website that you can buy stuff. It's pretty cool. They're doing really well. Also this week, AdTech God does a podcast with the Vanderhook brothers to hear about the Viant Iris TV acquisition. So AdTech God is stepping on my toes. He's starting to break news, not just doing his fun meme stuff. So good for him. But it's definitely worth listening to. All right, let's get into it. We'll have Marc on the show. All right, Marc Guldimann, the CEO of Adelaide Metrics. Thank you so much for being here.
Thanks for having me, Ari.
Adelaide has been a pretty frequent advertiser on Marketecture, but this is not paid content. We really wanted him on here to give us his perspective on attention, because attention is kind of a buzzword. So why do people care about attention?
So I think that people care about attention, at least in media, because all media isn't equal, and the metrics at their disposal today don't really do a good job of helping them suss out what's high quality and what's low quality. In fact, a lot of the metrics that are used by the market today have been fully gamed, like viewability. And if you optimize just like whole hog towards the most viewability and the lowest CPM, you're going to get some pretty low quality media.
Right. So you think attention is not gamed, that's different and is more indicative of quality media?
Well, it depends. I mean, some attention metrics could definitely be gamed, and others, I think the gaming aspect of it comes down to if the metric is transparent or if the weights on the different sort of measures that are used in the metric are more opaque. That's definitely something that we have a strong opinion on, which is in order for a metric to be trusted by both sides of the market, there needs to be a little bit of opacity.
Why? Why does there need to be opacity?
Because otherwise it's gamed, right? So take your FICO score, for example, or take the Google search engine results page, for example. On your FICO score, people have a general idea of how it's used to judge their creditworthiness, but the actual algorithm isn't public. And if it was public, people would behave in a different way that wasn't really authentic. And the more a metric is gamed, the less useful it is to the marketplace.
Right. I remember the human people used to always say that about their bot tracking, which makes a little more sense because bot is obviously a adversarial relationship. Are you applying that sort of adversarial with media companies, that they're going to try to make things more attention grabbing if they understood how it was being scored?
Well, yeah, I think in general, most markets are adversarial. And once the seller understands the way that they're being measured in a market, they're going to try to deliver the cheapest product, which clears that hurdle. It's just like it's an inherent side effect of a free market, right? Which is why after viewability came into vogue, all of the ads became viewable and they all shifted to the top of the page.
But that was good. That wasn't cheating. That was the intention.
I don't think the intention was to litter the top of every web page with 50 different placements and 25 auto-playing videos, or like create this sort of the substrate for MFA sites to become popular.
Well, yeah, I think that a lot of it was the buyer taking viewability as a be all and end all when it was just a attribute. Yeah,
I mean, it should have been like a sanitation metric. I don't know if I'm using the right word. It should have been just like
cleanliness metric. So someone once told me there's 24 major attention vendors currently in the market. Is that accurate?
That sounds a little low. You might need to update that number. There's a few launching, it seems like, every week. It's a crowded space.
Is that good or bad?
Oh, I think competition's great. I think that, in some ways, competition's awesome. There's no question that having other people in the market have forced us to make our product better. The one downside is that I think the biggest threat to the widespread adoption of attention metrics today is bad attention metrics. We have a harder time selling into people who have tested an attention metrics vendor and had it not work than people who are sort of greenfield and are currently using viewability.
Without turning this into a commercial for your company, can you give us like a overview of the different methodologies for attention that are out there in the marketplace?
Yeah, sure. And I will try to make this as non-commercial as possible.
Please, thank you.
We view attention in 4 waves. The first wave is viewability and video completion rate. A lot of people don't think of those as attention metrics, but since the job of media is to deliver attention to creative, and those are proxies for the quality of media, they are de facto attention metrics. So that was the first wave of attention metrics. The second wave was using like viewability plus. So instead of stopping the counter at 1 second or 2 seconds, you just keep it running and you figure out how long was the ad on page for. It's pretty predictive, especially if you have what we call like a politely interruptive format where it captures the user's full attention for amount of time they control. But obviously, it doesn't take into account all the context. Like you can have a little tiny crappy banner ad that's on screen for a long time, and it's not necessarily a good placement or a good impression. Third wave is the idea of using viewability metrics and eye tracking to predict gaze duration. This was definitely an advancement over viewability plus. We actually ran an ad network where we were selling unpredicted gaze duration called Parsec. It works really, really well. The big downfall of this is that the dependent variable in the gaze duration approach is gaze duration and not business outcomes. The other big problem is when you optimize towards gaze duration, you have some unintended effects on audience. There's creative incentives that are a little bit weird. Like you don't want the creative that captures the most attention. But there's not a lot of like, unless we get generative AI into the DSPs, like optimizing the creative to get like the uncanny valley and like freaking weirding people out and that attracting attention.
Coincidentally, gaze duration is my drag queen name.
I don't have one of those, Ari. Maybe it was like the street I grew up in. And the name of my first startup, Roosevelt Sponge Cell, I guess.
That's not bad.
That's not bad. All right, what's the fourth? Okay.
All right. So here's the thing. On the audience side, if you optimize your campaigns to the longest duration, you get old drunk people, right? Old people pay more attention than young people. Sober people pay less attention than intoxicated people.
Wait, are intoxicated people just staring at banner ads? Is that what the kids do nowadays?
They're just moving their screens really slowly, right? Like people that are intoxicated take 33% longer to read than people who are sober. And the more intoxicated you get, the longer you take to read things.
Is this all drugs or just alcohol? Crystal meth probably has a very low impact on attention.
I was painting with a broad brush. It's alcohol.
Wait, Hemingway, was it read sober, write drunk?
No, it was write drunk, edit sober.
Yeah. Maybe, weed is legal everywhere now, so maybe that's also having...
So old drunk people are responsible for the attention economy.
No. Old drunk people are what you get when you optimize towards the maximum amount of attention, which is what you don't want. Like you don't want the maximum attention. Like you get that, the Clockwork Orange joke, which I think you made at me on Twitter like 5 or 6 years ago with attention metrics. Like you don't want the maximum amount of attention. What you want is the highest probability of attention on your creative. And that's what the fourth wave of attention metrics are. Instead of saying we're going to maximize the amount of attention, we maximize the probability of attention. There's a great researcher named Dwayne Varon, and he says the biggest risk an advertiser has is no attention. And that's what they need to mitigate. And so that's what I think that the fourth wave of attention metrics solves.
How correlated are these things to viewability? Like I would think at some level they're correlated. Like if you have no viewability, if you don't no attention.
That's right.
If you have high viewability, you probably have high attention. So why is it so much better if the two metrics kind of march side by side?
For one thing, there are sub-viewable impressions that get enough attention in order to work. Anybody that buys on Instagram or measures Instagram knows this, and the meta folks will talk about this all day. So,
can you explain that? What do you mean sub-viewable?
75% on screen for 0.75 seconds.
And they get attention.
People can notice a brand. I wish I had some data in front of me on this, but you can definitely notice a brand in under a second.
So is that a flaw?
It's like the opposite
with viewability.
It's like the opposite of the drunk effect, right? Where if you're locked in and just like scrolling through Instagram or a platform like that, like you're probably extremely attentive.
The meth effect, right?
Yeah, except everyone under 25 has it without drugs.
So that's on the under viewability side. On the over viewability side, viewability treats all impressions that cross that threshold as the same, right? And there's definitely a divergence in quality once you cross that viewability threshold. There's ads that are like massive and take your full attention, that might look less appealing than ads that are tiny and capture a very little bit of your attention if you're using viewability, and especially if you're using video completion rate, right?
You gave us a very good explanation of sort of the sort of waves of attention. I like that. But on the technical level, what are the methodologies that are out there? Because my understanding is like you have some attention companies that have opt-in panels, like paid panels, where they like literally track people's eyes and pay them. And then you have other folks who maybe are just using some JavaScript and using some inference about what the mouse cursor does and stuff like that. So can you lay out what the methodologies out there in the wild are?
Yeah, so I think everybody should use eye tracking data. Like you need to understand human attention. You need to understand how humans engage with media in order to predict attention.
How much would you pay me to track my eyes? Like, what's the bounty?
Oh, let's see. I think it depends on your demographics, socioeconomic.
I'm an old drunk person. How about that?
Nothing. $10 a month. We buy a lot of eye tracking data. We don't do our own eye tracking. And in fact, I think that's an advantage because like we get a lot more diverse eye tracking data.
Wait, are there marketplaces where I could buy eye tracking data?
There used to be. I think there was a company called Toby that was trying to set up something called ATEX or Attention Exchange. I don't know how well that went. But we like it. Ironically, the people who are now in the attention space were eye tracking companies. Like about 6 years ago, we were licensing a lot of their data, and they kept asking us what we were using it for, and we showed them, and then they pivoted. So take that for what it is. But in any case, you need eye tracking data in order to understand like how humans engage with media. But the difference is what's the dependent variable? Like in the third wave of attention metrics, the dependent variable is the duration of gaze. In the fourth wave, the dependent variable is actual business outcomes. And I'll explain. The best analogy is credit ratings. If you want to rate the quality of something, there's a lot to be learned from either like FICO or Standard & Poor's or Moody's. If you're going to build a new credit rating, you'd do three things. You'd first work with researchers, understand what are the attributes of people that make them more or less likely to pay back debt. Then you would go out in the market and you would gather all of that data about people and build a model. And then you would get historical debt repayment data, and you would train your model so that it's informed by research, but predictive of actual historical data of people repaying debt. So the best approach to attention metrics is doing the same thing. You work with attention researchers to figure out what are the characteristics of placements that make them more or less likely to pay back debt, not to pay back debt, to drive attention. And then you go gather that data about every placement in the world. You build a model, but then you get outcome data and you train your models so that the metric is based in attention and informed by attention, but predictive of outcomes. Because the job of advertising is not to drive attention, it's to drive actual business results.
Okay, so that kind of tees up my next question, which is what proof do we have that attention drives outcomes?
There's plenty of proof out there. There was an unfortunate article in Ad Age a few weeks ago, maybe a month ago at this point, that said attention doesn't move sales or other brand outcomes.
A great article.
It was a burner.
Great headline.
It was like the headline could have just been like, some attention metrics work, other ones don't. Because what they found in the article, it literally said, Kroger did a test, it didn't work. Oh, but look, Adelaide has a ton of proof, and one of our competitors, Lumen, also has a ton of proof to show that attention drives outcomes. Every single client we work with, we make them go through a very rigorous test where we prove to them that attention drives more efficient incremental outcomes than viewability or video completion rate, whatever else they're using.
Right.
There's a large body of work that proves that attention drives outcomes.
Does it always work? Or, I mean, Kroger, it didn't work for Kroger. Why do you think it may work for one company, not another?
Well, depends on the vendor you use, right? They were using Double Verify. And I mean, I don't know Double Verify's products any better than anyone else, but I don't know how much eye tracking data they use. And it doesn't surprise me that the product that comes from the makers of brand safety doesn't work very well.
Burn. So that also tees up the next question, which is, what is the current state of the big guys offering this? Because obviously your company's small. You mentioned Lumen, which is also a pretty small venture-funded company. IAS, DV, Nielsen, Comscore, who offers an attention metric and who doesn't?
Yeah. So, I mean, the irony is Jonah at Moat sort of made this whole category over a decade ago. So I think they would definitely be in the lead if they were still around. The DV folks made their own product called Authentic Attention. They licensed data from TVision for their CTV product. But as far as I know, they don't have any eye tracking data in their sort of desktop mobile product. That product is MRC accredited though, just for desktop and mobile and in-app.
The MRC has an attention standard?
No, they've just accredited the Double Verify Authentic Attention metric as accredited. Outside of they're working on a standard with the IAB. At Adelaide, we've had our product in the under review for accreditation, which is what we just announced, and that's for omnichannel. That's for everything from web to digital out of home to CTV and cinema. IAS has a product as well that uses Lumen data. So they've licensed Lumen eye tracking data to use in their web and mobile product.
Did you say cinema?
Yeah, cinema. It gets a lot of attention.
Yeah, sure. How do you measure it?
So there's actually companies that have set up eye tracking inside of cinemas, and we've licensed that data. And actually the two biggest cinema companies, Screen Vision and NCM in the States, both ran eye tracking studies. They shipped us the data. We processed the data, and then we ran through our normal sort of 3-step process of using the research, gathering the placement data, then getting outcome data and training the model.
Is it 100% attention, or are people checking their phone?
It's pretty high up there.
Yeah.
I think, and it depends on if it's lights up or lights on or lights off. There's all sorts of factors that play into it.
People forget cinema, but it's literally the largest market in digital out of home, or it was for a while. Okay, so let's talk about the future. So what do you think is going to happen with attention metrics? Are they going to become a currency? Yes, no, and also just what do you expect to happen in the marketplace?
The nice thing about markets is that opinions don't really matter about currency. The market's going to decide if attention becomes a currency or not. And, there's two ways that currencies are made. You can make a currency via fiat, which is a bunch of people in a room that decide that 50% for 1 second is good enough to trade on. Or there's arbitrage-driven currencies. This is not like the typical arbitrage you have in ad tech. This is like a normal free market arbitrage where the buy side has asymmetrical information. They use that to make more educated bids. And over time, as the information used for arbitrage becomes more diffuse, the alpha that's generated by that information gets compressed, right? So the price of undervalued assets starts to approach its actual value. And at that point, the buyers with the data, at some point, like they're like, I don't want to do all this ARB stuff. I'm not an investment bank. Like, I just want to like go and buy media and have predictable, consistent outcomes. They show up with the new metric to a publisher and they say, hey, will you guarantee me this buy using this metric instead of using viewability? And then at that point, it's a market-driven currency. And we've already started to see that happen. So the Wall Street Journal announced recently that they're making guarantees based on our data. There are like A&E for a while was making guarantees on T-Vision data. So like it's definitely starting to happen. And it's really, really interesting because it's market-driven and not driven by like a bunch of old white dudes in a room.
Driven by a bunch of old white dudes. They're just in different rooms. So when you say guarantees, so that's like basically there's a currency like impressions on an IO with the Wall Street Journal, let's say, but they're also putting a provision that is going to be at least X% attention based on your metrics.
Yeah. Well, I wouldn't say we don't deal in percentages. We deal in ratings. We rate media placements, and in order for a guarantee to be met, the ads need to be served into a placement which reaches that minimum rating. In our industry, anything that's in a contract is considered a currency. And so it's sort of like, it's not really using the word technically correctly, but I think that if a guarantee is in a contract, then it could be considered a currency.
Yeah, I think so. I think often in the TV business, they talk about secondary currencies. You Nielsen for ratings, and then you have a T-Vision for something else or Video Amp for something else. So that's kind of that characteristic. Awesome. Well, thank you so much for this great overview. I learned a lot about attention and about the whole market. I guess we should have disclosed that, Eric, you're an investor, right?
Yeah, my fund invested in Adelaide this year.
Cool. And I'm an investor through you, but I'm also an investor in Lumen through First Party Capital. So I'm maxing up my attention portfolio. All right. We will be back with news of the week with a lot of earnings, some controversy around Zeta, and Viant buys Iris TV. So stand by. This podcast is brought to you by AdRoll. AdRoll is a name a lot of advertisers are probably familiar with. A leader in high-performance digital advertising for 15 years, AdRoll is a brand you can trust to deliver strong ROI across display, native, and paid social campaigns in one platform. Get in touch with an account expert or create a self-service account at adroll.com/Ari today. That's adroll.com/ARI today.
All right, and we're back. So on the docket today, we have earnings and some public market drama, some M&A, a Forrester survey that Ari, you're mad about, ads coming to Perplexity, and a Bitcoin prediction from Mark G. So we have something for everybody today. Quick, just kind of recap on public market stuff. So last week, Ari, you were in UK. We did News of the Week. We focused a bit of time on AppLovin, who is now the most valuable pure play ad tech company out there. TTD and Magnite subsequently both reported didn't have blowout earnings and stock going crazy like AppLovin did. But I think there were a couple of interesting things on TTD and the Magnite front, both of which are around CTV. So Magnite CTV revenue up 23% year over year. Barrett actually had an interesting comment, somewhat cagey details, but expects Netflix to be one of their largest customers by 2025. Elsewhere, Netflix reported that its ad tier is now up to 70 million users. The other thing interesting on the Magnite front is that curation is up 100% year over year. So tracking with everything we've been talking about. TTD overall revenue up 27% year over year. They don't break out CTV like Magnite does, but Jeff said it's the largest channel now. Video, which encompasses CTV, plus OLV, is almost 50% of total revenue. So next year, TTD will be a video company.
It's exciting stuff. I like the Netflix point. That's really interesting. I think, here's my perspective of Trade Desk versus AppLovin, because they're pretty different approaches and different companies. I think historically, the most revenue has accrued to companies that create marketplaces where you are on both sides. buy and sell. And when you're only on one side, you're always at the risk of being disintermediated from your supply or your demand, depending on which side you are. And so, in a sense, it's kind of remarkable that the Trade Desk has done so well only being on one side. And if you look at their strategy of OpenPath and UID2, they're effectively trying to cobble together the second side. It's like a federated approach instead of owning it. Whereas AppLovin is on both sides, and that's their secret sauce. And Eric Suffert's excellent newsletter covered this week. So it's an interesting comparison. They're not competitors with each other. They're just interesting to look at side by side as two different approaches to the same problem.
I think it's interesting that I read an interview with the AppLovin CEO where he talked about them taking the risk out of it for advertisers. So they're guaranteeing outcomes, sort of like the principle-based version of DSP, I guess. I don't know. But like their value proposition is guaranteeing installs, if I'm right, or doing some sort of like lower funnel activity guarantee.
That's been their business model, just driving downloads for mobile app developers across mobile apps. More recently, they've started to open up that inventory to other performance marketers, and they're selling it just in that same way, like a PMax or an Advantage Plus. My sense is that's not where a lot of the revenue growth has been today, but it could lead to a monster business in the future. That's actually back to you, Ari. That's an interesting point. You said this in a different way yesterday at the Bid Switch event, invite only. You had a fireside with my partner Josie. It was really, really good. Basically the sort of bull case for ad nets. It's because they're on both sides, right? And you can build a bigger business as a result. Am I right in thinking you're kind of connecting those two?
Yeah, I think the beauty of the ad net is that it gives the customers exactly what they want. And if they don't get what they want, they could go somewhere else. As opposed to a software product where you're potentially locked in for years and you have training. And AppLovin's executing a really good ad network model. People, there are a lot of critics, people chiming in on Twitter and whatnot. But I always like to remind people that the customers are choosing to work with them. So let's just assume the customers are smart instead of assuming the customers are stupid.
Well, the customers are following their short-term incentives, which is to drive the cheapest possible business outcomes, which is it's great for AppLovin in the long run because they learn how to do that more efficiently than the customers do. And so the customers are sort of addicted to that.
It's also relevant the way they position themselves. They don't say we're the best ROAS you're going to get in the universe. They say there's only so much you can get out of search and social. Right. So they're sort of acknowledging that their ROAS is probably not as good as Meta, which it probably isn't. But it's above the line where the sort of cost of capital makes it worth investing to get new customers. The LTV CAC calculation still makes sense. So it's a very solid business. I also, one of the dark horses here is CTV, where they acquired Whirl, which is a really interesting company. And I think you'll see a lot more from them on the CTV front.
Yeah. Makes total sense. They're the one to watch. All right. In some not so good public company news, Zeta Global, which we've been talking about, just given their recent acquisition of Live Intent and the business being valued quite largely, is no longer in the public markets valued what it once was. The stock was down 37% yesterday because of some allegations over consent farming. Before we get into it, consent farming, new term to you guys? Or you've heard it before?
It's lead gen. It's lead gen.
Yeah.
Right. Lead gen's always been a really dirty part of the ad tech business.
Yeah, it's the dirty part of lead gen. So consent farming is luring individuals to provide data under the guise of providing benefits and rewards. The data is then sold, and the consumer often doesn't receive any of the promised benefits. Like, give us all your data and you win an iPhone, and the iPhone doesn't show up. This is
right,
as old as the internet.
More, like sometimes it's a search arbitrage. So you search for like doctors in Detroit, and they're like, we'll find you the best doctors. You give them the info, and then they sell the information to a bunch of doctors. And it's legit. It's just sort of a search arbitrage because you'd be better off on the search having found the doctor's site the first time instead of the intermediary who collects the data.
All right. So how did this go back to Zeta? Zeta, and again, these are allegations from a short seller. Short sellers benefit when stocks go down. Zeta allegedly, according to this short seller, uses two-way deals with consent farms to inflate revenue, raising round-tripping concerns. And Zeta's own consent farms apparently have some O&O, reportedly collect consumer data under false pretenses And again, allegedly, according to a short seller, drives most of its growth and 50% of adjusted EBITDA, which risks FTC action. I don't know anything about this stuff. I had no idea this was such a big part of Zeta's business, but this is wild.
I think Zeta, I have absolutely no basis for saying the short seller's right. If there's anything, I have no information. But I will say that Zeta hasn't done itself favors by having a very confusing discussion about what their actual business is. I think we've talked about it previously on this pod, that kind of we're all professional advertising tech people, and we kind of have no idea how Zeta makes money. And it's one of the biggest public companies out there. And you read their documents, it sort of sounds like they do email marketing, but do they? They have all this data, all these consumers, profiles, sort of like, well, how does that actually work? I've never had any idea. So, yeah, I guess it's kind of an easy target if you find the worst websites affiliate with Zeta and you show them, and there's some other businesses that are totally legit. I have no idea. Yeah, the other thing in the allegation is they're alleging two-way deals. So where they're paying some of these content farms for users, and then they're also maybe driving traffic to them. So there's revenue going both ways, which is a not illegal thing to do, but it brings up a lot of accounting issues, and it can be a way to manipulate earnings to some extent. So that's the other allegation from this company. Then we should mention the company's called Culper Research.
A short seller. Mark, got anything on this one?
Nope. No, I mean, I think I feel like if short sellers dug into most of ad tech, they would find some sort of questionable things in a lot of places.
One other little point here. So a couple of weeks ago, we talked about OpenWeb and their CEO. By the way, the CEO lost his lawsuit, so I believe he's being kicked out officially.
He's out.
Yeah, we didn't have that in the news, but I saw it elsewhere. So the original CEO got replaced by a new CEO, refused to go, brought them to Israeli court. He lost in case. But none of that's relevant. What's relevant is we were skeptical about OpenWeb's business model because it's effectively the comment section of a bunch of websites. Well, Zeta's business model is the comment section of a lot of websites. One of the main sources of data is Discuss, which they purchased many years ago. So there's sort of an analog there that this is kind of like very similar to OpenWeb. Let's say that.
Yeah, that's interesting. Okay, we'll move on. Some M&A news. Viant acquired Iris TV. Iris TV was an investment by my fund, and I believe a personal investment by you too as well, Ari. So plan is to keep Iris as an independent business, but I think also use that data to support Viant's growing CTV business. That's your take?
Yeah, I think the Vanderhooks just love a nice, juicy, cheap asset. And I haven't listened yet, but AdTech God actually got the Vanderhooks on his pod today. So you should listen to that. You probably would learn a lot more than us speculating. But I think they have aspirations to use a lot of data and to be a bigger player in CTV, and their stock is skyrocketing. So, good for them.
Did they disclose the price?
No, the price wasn't disclosed, and neither of us are at liberty. So back to the Vanderhooks, though. The Vanderhook or the Viant 2024 arc, it's impressive. So they came out with the AI planning tool. They made their first acquisition as a public company, and the market is rewarding it. Stock is up 136% year to date, and TTD, as a comparison, is up 75% year to date. So these guys are doing well, and they've been at this as long as anybody.
Yeah, I think the DSP business is unfairly maligned because obviously you've had flameouts like MediaMath and others. But really, if you execute a DSP business well, it could be quite profitable. I mean, you have private companies like Basis and Simplify that are really successful companies. And Viant's public, so they have to do it in public. But there's no fundamental reason why the DSP business is a bad business.
Mm-hmm. Yep, totally agree. All right, you're mad. All right, about
I'm disappointed.
The Forrester SSP survey.
Okay, let me just run through. So I didn't read the whole thing. It was just, the typical Forrester chart with the leaders, and I don't have it in front of me even because I think they asked everyone to take it down. This is a joke. This is just an embarrassing joke. Let's just go through the jokes. First of all, it's an SSP survey. No one uses the word SSP anymore. So they're already on their back foot by using a term that's totally outdated. Secondly, who is this for exactly? If I'm a buyer, a DSP or a buyer, I don't choose SSPs. I just buy whatever inventory I want. If I'm a seller, I don't choose SSPs. I use all of them. Have you ever heard of header bidding? There is no such thing as an SSP buyer. It's not a buying product. You don't buy it. There's no CIO somewhere evaluating SSPs to go, I think Magnite's the leader. No, that makes no sense. Next, there is no one SSP market. There's a video market and a banner market. They're totally different. Don't put them on the same chart. Last, the number one player, by far the leader in the industry, is Google. We have to acknowledge that. AdX has more than 50% market share. They are considered a laggard on this chart. It's a joke. It's a total joke.
More specifically, and maybe even funnier, Google is being termed a challenger.
A challenger. They're a fucking monopoly. The actual government is going to declare that product's a monopoly. And someone at Forrester is like, I've heard of this Google company. They seem really innovative. Maybe they'll challenge them. For God's sakes, just stop publishing this crap. Just like, it's not even worth criticizing. It's just an embarrassment to everyone involved. It's like the sort of thing that you're embarrassed by when you see it. Like, just as a reader, it's embarrassing. Forget the publisher.
Everybody knows this is pay for play, right?
Everyone says that. Is it not? I don't know. Like, it's what the pay for play. You don't get better rankings by paying. What you do is you manipulate the questions. So the way this thing works is the analyst comes up with a spreadsheet that's got like 10 tabs in it, and each tab has questions. And those questions are highly opinionated. And the analyst has a say, of course, but if you're a paying customer of the analyst, you might have a meeting and say, what's really important is audio support. I think audio support's the future. And so you end up with a new tab that's like audio support. And, if you might be a vendor that doesn't do audio support, suddenly you're really on your back foot. The other thing is qualifications. So, there's probably like 60 SSPs out there in the world. Where do they draw the line about who's on the chart, who's not? They'll come up with some arbitrary number. Like, they'll say you have to have a certain amount of gross billing, plus you need to have at least X number of named Fortune 500 customers who you put in case studies. That number will automatically disqualify some real challengers. And I'm speaking a little bit out of personal experience because Beeswax has never listened to any of the DSP ones, even though we're the 5th largest DSP in the country. We couldn't get on any of the Forrester reports because the qualifications were wrong. And actually, they changed the qualifications after we had filled out the survey and spent hours and hours on it. We got this little email like, hey, we changed the qualifications. You don't have enough Fortune 500 customers. You're out. So it's not exactly pay to play. It's more like pay to influence.
My question is, Ari, do you feel better?
I do feel a little better.
Felt like you had to get that off your chest.
Thank you.
You're welcome. Tune in next week for Weekly Therapy with Eric Franchi. Okay, well, let's keep going. We have an update on Everything is an AdNet, trademark Eric Seufert. So ads, we've known this from some rumors and other kind of scuttlebutt that ads are coming to Perplexity. They put out an interesting post on their own site discussing this. I thought it was interesting from two standpoints. So, number one, they're not just slapping some standard IAB units on the page and calling it a day. They have created a very native, basically sponsored follow-up questions. So you ask Perplexity a question, you then get a list of follow-up questions to dig in further on the topic. There'll be a sponsored one. It's clearly labeled. It looks really good, quite frankly. Question is, about how engaging it'll be. They've got some flagship brands already signed up. Indeed, Whole Foods, a couple of agencies. But the other thing that was really good was the post itself. And, there's this always consternation in the industry about, users don't understand the value exchange and so on and so forth. And I thought they did a really good job of explaining why they're doing this, why it's important, how it's going to fund the core product. So we'll put a link to it, but I thought it was well done. Did you guys take a look?
Yeah, I think it is interesting in that if you think about the search as directing people to a website, and that's not the goal anymore. Right. The goal is an answer. You can ask a question like, how should I plan my vacation in Cancun? And then it's pretty obvious you can have some really great opportunities to be like, is the Sandals Resort all inclusive or not? That sort of thing, which could be actually quite a bit more valuable than just clicking out to some webpage.
Yeah, no, that makes a lot of sense. I would assume these are high attention units, Mark.
We haven't studied them yet, but I would agree that they're probably pretty high attention, pretty engaged people.
Yeah, we should keep an eye on this stuff because this ends up being probably the format of the future as LLMs start to become more of a consumer product. All right, Mark, we're going to clear the deck for you. You have the hottest take of the week, and it's related to Bitcoin.
So Bitcoin's up by 50% in the past month, which is great.
Yes, sir.
I'm long myself. But the downside is it means the inevitable return of the ad tech blockchain scammers who want to take every part of the ad tech ecosystem and decentralize it, like weird ideas like putting your ad serving logs on a blockchain or using the slowest database ever created to store all of your personal data. And so why we went through this, I think it was 5 years ago when Ethereum first came onto the scene and was popular. And so, I think inevitably we're going to start to see people, maybe it's going to be like Gen AI distributed, like DCO, stupid ideas. There's like one use case for blockchain, and that's like allowing for trustless transactions of digital assets. And the irony is like one digital asset is money, but the only other like real, truly only ephemeral digital asset is digital advertising. And so there is a use case for blockchain and digital advertising, but it's likely just like, the digital asset being the opportunity to serve an ad to somebody. And so if you could tokenize that, like maybe that's an application of blockchain and digital advertising. But I don't think all this other stuff is it's such a waste.
So as far as I know, I can only name 3 sort of blockchain adjacent companies that are in advertising. There's by far the winner is the Brave browser, which has nothing to do with blockchain. They just raised all their money on a fake token. So now they're just a browser that has hundreds of millions of dollars in the bank. 2 is this company called Permission.io that I really don't know anything about except they DM me on Twitter all the time. And 3 is Antonio Garcia, like attribution
Spindle.
for
Spindle.
Spindle, yeah.
Yep.
Do you know any others, Eric?
No, there's been a lot of companies that have tried and ultimately ended up pivoting, and a lot of companies that tried and failed. And I think that, Mark, you raise a couple of good points. I think the applications are going to be, the next or the sort of like ultimate next value creator in blockchain. The real question is around its applicability to digital advertising. And I think what Antonio's business is doing is interesting. It's attribution and using basically wallet data to measure it, right? So if, everybody has a crypto wallet, you can then do some interesting attribution based on-chain activity, but the on-chain activity has to happen.
Yeah, it only really works for marketers who are also on-chain, right? Where the conversion is on-chain. All right, well, let's call it there. So I think there was a great conversation, a lot of news this week. So Eric, thank you for news of the week. And Mark, thank you so much for telling us and teaching us about attention.
Thanks for having me.
All right, everybody. We'll see you next week. Bye-bye.
Thank you for subscribing to Marketecture. New interviews are added every week at marketecture.tv and your favorite podcasting app.
Thank you for listening to the Marketecture podcast. New episodes come out every Friday, and an insightful vendor interview is published each Monday. You can subscribe to our library of hundreds of executive interviews at marketecture.tv. You can also sign up for free for our weekly newsletter with my original strategic insights on the week's news at news.marketecture.tv. And if you're feeling social, we operate a vibrant Slack community that you can apply to join at adtechgod.com.